Welcome back to the You Should Crypto channel, the channel where you learn about crypto to make better crypto investments. Today we're going to answer the question, why and how to backtest your crypto investment strategy. But first we have to know what an investment strategy is. So an investment strategy is a plan that decides what you buy, when you sell based on rules. To give a comparison of what is an investment strategy and what is not, when you deploy capital into the market when you see fit, it is not an investment strategy because your actions do not follow a plan. But when you lay down a path for your future actions, it is an investment strategy. But having an investment strategy does not mean you make profit. So you should ask yourself this question: is your strategy silently bleeding you dry? In one of the previous videos I made, I covered the 3 most common investment strategies, which are lump sum investing, value averaging, and dollar cost averaging. And in that video we saw that our gains are heavily dependent on our strategy. With the same chart but a different strategy, you can be negative or positive. Let's take an example to illustrate that. So here we have a chart, and we are going to use 2 different strategies. The first one is the contrarian strategy, where you go against the market, and so you buy when the price goes down and you sell when the price goes up. The buying points are marked by the blue dots on the chart. Then the second strategy is the right momentum. So you would only buy when you see that there is an upward momentum. And that is why all the magenta dots are placed at the tops of the chart. Now here with the same chart, the contrarian strategy would be positive, but the right momentum strategy would be negative. And so with the right momentum strategy, each dollar invested would be a liability. And here comes the benefit of backtesting your strategy. Had you backtested your strategy beforehand, you would have known that the contrarian strategy would have been the best here. And I learned it the hard way because when I started investing in crypto, I never backtested my strategies. So I just invested randomly in a coin named Filecoin. And that led me to put my portfolio down 50%. But it does not have to happen for you, as after this video you will be able to backtest your investment strategy to make sure you stay positive. Jim Simons, one of the most notable investors in the world, said, "Our scheme is to analyze for data and markets to test for statistical consistency over time." And this is exactly what strategy backtesting is about. So how does strategy backtesting work? Well, first of all, what's the purpose of backtesting? Well, the purpose of backtesting is to keep you alive until a parabolic move comes, but also to maximize how much you own when the parabolic move comes. Because if you do not hold enough coins when the price goes up, well, you're underexposed, and so you get less of a reward than if you had more coins. And lastly, the purpose of backtesting your strategy is to avoid losses that kill exposure to upside. If your strategy leads you to get liquidated before a big leg up, well, firstly you won't be too happy, but above all your portfolio will stay in the red. So the first step of backtesting your strategy is to define your rules. Your rules will dictate what you do when you do it. So for example, a rule can be buying when the price crosses the SMA 200. SMA 200 meaning simple moving average, and the 200 means on the last 200 units of time. So every time the price of the coin you hold crosses the average price of the last 200 units of time, well, you buy. Now secondly, you have to choose a past time period. This is the period on which you are going to backtest your strategy. So for example, from 2022 to 2025. Thirdly, you would run the rules on the historic price data. So you take the price history of any coin and you run your rules on the data. And after doing that, you will get a P&L, or profit and losses, and you will get a path, but I'll explain what the path is in a few minutes. Lastly, you measure the results. Based on your objective, you judge if the results suit you or do not suit you. Now here is something that someone who is not good at investing would say: if backtesting works, everyone would be rich. Well, that is not exactly true. So here's what you have to know about backtesting. Strategies are path dependent. The path is how the end result is achieved. And because strategies are path dependent, returns are also dependent on the path. But let's take an example to illustrate that. So let's imagine 2 different coins but with the same start price and the same end price. The first coin would go from $5 to $2.5 and then end up at 10. And the second coin would go from 5 straight to 10. The end performance of your portfolio would be 100% for each situation. Even though the first coin went down 50% in the first move, it managed to climb back up with a plus 300%. So far, this completely contradicts what I said. With this example, the strategy is not path dependent, because with 2 different paths, we have the same end result. But that is because it is only a theoretical situation. Let's take a realistic situation to illustrate that. So we have the coin that went from $5 straight to $10. On the chart, you can see what the price action would have looked like. So the first step is you buy and you hold the coin. Thanks to that, you would have a good exposure to the coin, and you would end up having good returns, totaling 100% if you follow the example. Now, let's take the other coin, but with a realistic situation. We would buy at the start of the chart, but we can clearly see that it's going down in the first phase of the chart. So we're more likely to panic sell at the bottom. So let's imagine we panic sell. Then when we see the price going up, we do not want to miss the opportunity and we want to get back the money we lost. So we buy higher. And because we have less coin than we should have because we sold and then bought higher, well, we end up underexposed. And so at the end, we have bad returns. And so despite the fact that the start price and the end price are the same, the returns might not be, because we have to account for everything that goes through that phase. And this is the path dependent. Same start, same end, but different result because the journey was not the same. So backtesting your strategy won't save you from human mistakes. But here comes the magic. Backtesting allows you to see if the strategy fits your psychological profile. After backtesting your strategy, you will understand how it behaves, and so on what type of market it should be used. And so if your strategy works best on high volatility coin and you can't stomach the volatility, then you know that strategy is maybe not for you. Alright, that's great, but let's touch on something even more important. Strategies must adapt to market conditions. Investing strategies operate on markets, but markets change. The market changes are called regimes, the type of market environment, and there are three main regimes. The first one is the one everyone wants. It is the bull market, the phase of the market where we are continuously trending up. This is the regime where it is easier to make money because you just have to hold your coins and they will go up in value. The second regime is the sideways market. The sideways market is going up, but it is also going down, and so both movements cancel out and we get a range. The price goes up and down in the same zone, and so on average the price stays flat. It is possible to make money in that regime, but it is harder than to make money in bull markets. And the last regime is the bear market, the market nobody wants. This is a phase of the market where we are continuously trending down, and so if you just hold your coins, they will have less and less value over time. This is the market where it is the hardest to make money in. Now, strategies must be adapted because strategies are not one size fits all. If you use the same strategy for the three different regimes, you are going to get wrecked. For example, in a bull market, you would rather buy and hold, but in a sideways market, you would prefer to buy the dips. And in a bear market, you would likely DCA because every time you buy, you lower your average buying price. And so when the market goes back again, you will enjoy having a low average buying price. Now, obviously those examples are really simple, but it is just to illustrate the situation. But the point is, backtesting allows you to check if your strategy fits the regime. Let's take an example. Let's use value averaging. On the chart on the left, we have a sideways market, but on the chart on the right, we have a bull market. The end result would be that on the sideways market, we capture volatility, but on the bull market, we would end up underexposed. Now, if you do not know what value averaging is, I would recommend you watch my video on the 3 investment strategies. Strategies are affected by market conditions, so your strategy has to fit the market structure. The market structure is the structure under which the price moves, and there are 2 factors. The first one is the direction, and the second one is the volatility. The direction is simply where the price is going, so it can go up, it can just stay flat, or it can go down. And those are basically bull market, sideways market, and bear market. Now, the volatility, on the other hand, is the vertical force at which the price moves. So if the price has sharp movements, or if it is smoother across time. And it is important for us to understand those 2 concepts. That is because they affect the market structure, and the market structure will impact the result of our strategy. The direction of the market is driven by market sentiment. So basically, do people believe it is going to go up, or do people believe it is going to go down? And the volatility is dependent on the size of the coin and on the tokenomics. When we link everything together, we understand that our strategy's performance is dependent on those 2 factors. So tokenomics affects investment strategies. But what is tokenomics? Well, the tokenomics is the economic design of a cryptocurrency. But what we'll focus on is only one part of tokenomics, and that is emissions, unlocks, and staking yields. The common link between those 3 things is that they increase the supply. Emissions means putting more token into the circulating supply. Unlocks are the right for people to use their coin however they want. So if my coins are locked, it's basically as if they do not exist. But when they get unlocked and I sell them, they enter the market. And so this expands the circulating supply. This can happen when early investors invest into a project. They will get a portion of the supply in return for their investment. But to prevent the price of the coin to crash right at its launch, the coins are locked for investor not to be able to sell it directly. But after some time, that protection wears out, and this is called unlock because, well, the coins are unlocked. And lastly, we have staking yield. Now, I won't go too much in detail because this video is not about tokenomics. But staking yield is basically staking your coin to secure a network, for example, and because you took the risk to stake your coins to secure the network, you get coins in return. Coins that then increase the circulating supply. So here we have a beautiful illustration of a circulating supply. The green part is the circulating supply, and the gray zone is what has yet to be created. Because of the tokenomics of certain coins, there are emissions, unlocks, and staking yield, which creates coins that are put into circulation. And so after this phenomenon, we get an expanded circulating supply. Or in other words, we have inflation. Inflation makes the price more expensive to move. And so volatility dies. When volatility dies, it changes the market structure because the price no longer moves the same way. And if it doesn't work the same way, well, it will affect your strategy's performance. But let's take an example to understand why volatility is killed by inflation. So let's imagine a cryptocurrency. It is currently valued at $10 a coin. There are 20 coins in circulation, and the market cap of the coin is $200. To move the price of the coin by $5, you will need to invest $100 into the market. Obviously, because if you want your coin to be worth $15, the market has to go up 50%, and so the market cap has to go 50%. 50% of $200 is $100. Pretty simple. But now let's imagine there's a supply expansion. So there is inflation. We expand the amount of coins in circulation from 20 to 40. We still keep the $200 market cap, but because we have twice as many coins, the price of one coin goes from $10 to $5 a coin. Now, with our new supply, to move the price by $5, we would need to invest $200 in the market instead of $100, because $5 is no longer a 50% increase but a 100% increase, and 100% of 200 market cap is $200. So we got a coin inflation, and we saw that the market gets more expensive to move, and so because it is more expensive, less people are going to be able to move it, and so volatility decreases. If you have a long-term strategy, you will get affected. And so you can backtest your strategy on coins that had a similar inflation as the coin you're investing in. This will tell you if your strategy is likely to continue to work in the future or not. Now we enter something people overlook, and that is that people are convinced things work until they don't. And that is the theory of reflexivity. The more a strategy is known, the less efficient it becomes. So let's imagine a market. The market is a flat line representing the potential gains. But as you can see in the market, there is a gap represented by that hole I drew. And that gap has the potential to give us bigger gains. When that gap gets noticed, investors are going to try to get in, whether it is a strategy that works better or whatever it may be. But the more investors try to fit in that hole, the less space there is for newcomers. And when that gap gets filled, it is no longer profitable. It can even go in reverse. One strategy that offered superior results when used by too many people can yield way worse results than average, and that is because the edge is too crowded. So thanks to backtesting, you will be able to have an indication on whether your strategy is used by too many people or not. So we saw the power of backtesting your strategy, but how do you actually backtest your strategy? That's what I'm going to show you. But before that, the goal of my channel is for you to increase your crypto gains thanks to the content I post. I spent hours studying the crypto market so you can better understand it and make better investment decisions. So if you want to support me so that I continue posting videos for you, well, you can subscribe to the channel. This will also ensure you don't miss anything. Alright, so how to backtest your own strategy on past data. I am going to show you a simple method for simple strategies, and for this procedure I am going to use two tools. The first one is the website CoinGecko, and the second one is Excel. So the first step is you need to find historical price data. So I chose Bitcoin, and to get the historical price data I went on CoinGecko. On the website you will be able to find the historical price data pretty easily. You can download the file and you're ready to go. So once you have the Excel file, you can open it and you'll have something like this. Now the price expands way more underneath, but because I do not have an infinite amount of space on the screen, I can only show so much. The third step is going to be to delete the unnecessary data. So truthfully, it depends on your strategy, but for now, we only need the price data. Next, we are going to define your strategy, and the strategy I chose is the two moving averages. As you can see on the chart, we have the coin's price movement, in blue we have one average, and in orange we have another average. Now, next we want to create the parameters for both moving averages, so SMA1 and SMA2. Remember, SMA stands for simple moving average, so SMA1 will account for 4 units of time, and SMA2 will account for 8 units of time. Note that I used those numbers just for the sake of the example. I did not try to maximize profit with this strategy, so you can actually choose your own numbers. Next, you are going to select each parameter, so 4 and 8, and rename them. So my cell G3 will now be called SMA1, and my cell G4 will now be called SMA2. Next, we want to enter functions to get both SMAs, and for this we are going to use the function average offset. Just copy the function and you're good to go. And obviously you do the same for the SMA2. Now, I am not making an Excel tutorial, that is why I'm not explaining the function. If you have any troubles, you can ask in the comments and I will gladly answer. And if you want me to explain this further in a video, you can also ask me to do that. Now, our two moving averages are tools for us to find entry points to enter the market. So the 8th step is to set entry points for our strategy. Here I want to enter the market when SMA2 is bigger than SMA1. So I just enter my function SMA2 smaller than SMA1. Next, we want to calculate the return of our coin. So we are going to add a column for our returns. And to do that, we are going to use a log function. But this only gives us the returns for each day. What we want is the total return on the whole history. So we are going to sum every daily return. But now the total return we have is in logarithmic term, which does not give us the real return. So the next step is going to convert the logarithmic total into a real return. And to do that, we are going to use the exponential function. Now, we calculated the returns for the coin, but we need to calculate the returns for our strategy. So to do that, we use an if function. If the position is true, then we will display the return. And if it is not true, so if it is false, we will display 0. Thanks to that, we have all the days in which we were invested in the market. And with that, we can calculate the total strategy return. And it is fairly simple. We're just going to sum every daily return we had on our strategy. But since our total strategy return is still in logarithmic term, we need to convert this into real term. Here again, we use the exponential function. Now, the last step is to make the tab readable. So you can add colors to better separate everything. And you can put the returns in percentage terms. So as you can see, over the time frame I used, Bitcoin went up 80,000%, but with this strategy we would only have had a performance of 60%. So definitely not a great strategy at all. The goal of my channel is to teach you about crypto so that you can increase your crypto gains. So if you don't want to miss the next information that might make you profitable, subscribe to my channel. I will see you in the next one.